Happy New Year, everybody. Joe Mass here, your Chief Investment Officer. It's that time of year again. It's time to look at the market review, kind of look back at 2024 and talk about 2025. So again, my apologies in advance. I'm a clock builder and I have a lot of slides, so I'm going to go fast through this. So again, I'll try to really highlight what it really means for you. But I do like to go in a little bit of detail just so you know what we're looking at and you can feel comfortable that we're paying attention to all the critical facts. Okay, so let's start off with a review here. As everyone should know by now, the S&P risk-on market, U.S. largest 500 companies, was a positive year, about 24%. And it was a pretty good year, right? We only broke the 50-day moving average 4 times, as you can see in the red circles. And so, it was pretty much a straight year up, a couple of scares along the way, but it recovered nicely. It outperformed the expectations of analysts at the beginning of the year. And so we ended up with very positive 2023 and 2024. So for the most part, we had momentum in equities. When we look at the Dow Jones, we also see that the Dow Jones Industrial Averages are above its 200-day moving average. And as we always like to look at supply and demand, you see that red line in the bottom chart here towards the end of the year. We did see the red line coming up, which means the sellers were in control. We want to see the black line above the red line, and that means that the buyers are in control. So as it sits today, it's about the 10th of January, and we are seeing the market pull back a little bit. So this red line, the supply is continuing to take over as we move into the new year. But for the most part, you can see that the suppliers, equities were in demand, and we see that manifests itself here. When we look at the sectors for the quarter, consumer discretionaries, consumer services, financials, and technology really led the way. And then below the S&P 500, energy, industrials, consumer staples, utilities, real estate, healthcare, and materials, all were in negative territory. For the year, the top sector was communication services, then followed by financials, consumer discretionary, and the S&P 500. You'll notice that for the year, all of the sectors of the S&P 500 were positive. Looking at asset classes, large cap growth in the NASDAQ, commodities, convertible bond, and large cap came back last quarter. We see that metals were at the bottom of the pack here. That's a globally diversified metals portfolio down here. Silver had a negative quarter, and gold. Of course, we knew the prior quarter, those metals had a very nice quarter. And for year to date, if we look at the full year, large cap growth took the number 1 spot, then gold, the NASDAQ, large cap, and silver rounded off the top spot. So metals all in all did have a good year, and we do expect metals to play a role in portfolios going forward. When we look at the breadth of the S&P 500, what we're looking at here is the S&P 500 had 352 constituencies up and 175 down. So there was a lot of breadth last year. NVIDIA was at the top of the list there. And then we can see here the super microcomputers and Walgreens really led the bottom of the pack. But for the most part, we had broader participation in sectors and in names, and that was good. And we'll talk more about that in a few slides. So I'm a valuation guy. I always like to look at valuation. Valuation matters to me. And so, is the S&P 500 overvalued? The way we're looking at it right now is that the current PE in the S&P 500 is 26. Based on the forward-looking PE, we expect that to be around 25. Now, what you're looking at here in this top panel is that this blue line is the long-term average, and then the 1 and 2 standard deviations above the average and 1 and 2 standard deviation points below the average. And so we can see that the market as a whole is up in this higher valuation range, but that doesn't mean that there's not more room to go, because we do see a forward-looking PE ratio lower than its current ratio, and that's good because holding the price, the numerator, constant, that means that we're getting earnings growth, and we'll talk more about that. Now, when we look at the equal weighted S&P 500, okay, it's currently at about 19.57, and it's looking to move to about 19. And so you can see that again here, it's really right about its long-term average. And so that's why you're hearing a lot of talk about equal weight. Looks to be a better value proposition than the S&P 500 market cap weight. And we'll talk more about that in a few slides as well. Now, this slide I know is a lot. This is what I do when I calculate the equity risk premium. and I try to find the return that would put the market in equilibrium. And so that number right now is 3.11. That's relatively low historically speaking. But what that means to you is that if you need an extra return over the risk-free rate to go into equities, your total expected return is going to be about 7.6%. So if the risk-free rate on that 10-year bond is about 4.5, and you add that equity risk premium to it, you get an expected return of about 7.6. Now, from consensus analyst estimates, they're expecting about 13%. Okay, so if the market can do 7% real return over the last couple hundred years, we're just a little bit above long-term trend. But currently for this year, looking 12 months out, the analysts think that we're going to have about a 13% return in the market. And we'll talk more about that in a few moments. Another thing that we like to look at is equity call volume. And so options are used to either speculate in the markets and give us price discovery. And so if there's a lot of people buying calls, which gives you the right to buy stock, that's a bullish factor. And so we see here in this graph, this middle chart is the S&P 500, and you can see that the call volume is above average. It's long-term average on that blue line, and that's a positive. That's positive for equities. When we look at small cap, we can see that it's below the average, and we can see mid cap as well. So, although we're going to talk about the expected returns on small and mid cap later, it still looks to be the most interest and attention is going to be in large cap. And if I don't say it later, if rates are a little bit higher right now than expected, and if rates stay high, that'll bode better for the large companies than the small companies. So, a lot of people have a positive outlook on small caps, and that might change if rates stay high. So based on the call volume, it's still showing that large cap is in favor. You've seen these charts before. What we're looking up here is the leading economic indicators in the green. The blue are the, kind of where we're at right now when you look out the side rear view mirror of the car, the coincident indicators. And the green are the lagging. That's like looking out of that rear view mirror. And so we do see that the leading economic indicators are still negative, and we'll talk more about that later. But so far, we have avoided a recession. And I don't think we'll have one in 2025. That might be different for 26 and 27, but at least for the first 3 quarters of the year, the majority of the year, we're still positive on equities, and then we'll see what the data shows. This red bar down here is the road that got us there, and that's the Fed. You see, of course, they came up, they paused, they're starting to come down, and so far we've avoided a recession. When we look at the economic activity now, the top panel or the blue and green lines are the ISM manufacturing and services index. And we want those above the red line, which is 50. Anything above that red line is expansionary. Anything below that is considered contractionary. And this, again, is a survey, so it's forward-looking. And we can see that the manufacturing is still below 50, but services is above. And so, we'd like to see both of those above 50. When we look at GDP, which is like looking through the rear view mirror because it's backward-looking data, we still have positive quarters of GDP. The bottom panel, we see the Fed rates, and this white line is the market. And so again, the market's been very resilient as these rates have come up. The market's still been coming up for the most part, had a little pullback, and it is continuing to react positively to the rate environment. Now, if the rates change or the economics change, the data will change. But right now, the market is cheering the Fed's decisions to pause and then lower rates. Okay, recession. One of the best indicators that we like to look at is the unemployment and the change in unemployment. And so the green line is the unemployment rate, which is still pretty low. The blue line is the rate of change in unemployment. Anytime it goes from a negative or 0 up to 1, we see a red bar, which is a recession follow. So we can see that went from 0 to 1, 0 to 1, and we've had a pretty consistent picture there. So we think this is a pretty reliable data point. So right now we are not quite back up to 1. It's just hovering there. So again, right now, as of today, it looks like we've avoided a recession. The Fed is going to be paying a lot of attention to its second mandate, which is unemployment. Remember, the first one's inflation. The second one is employment. So a lot of eyes and attention is on unemployment, and that'll be watched carefully. But as of today, again, this indicator is showing that we won't have a recession here probably this year. When we look at the yield curve, it just went positive. Remember, a negative yield curve is typically bad for equities. It's expecting harder times to come. And previously, recessions usually don't hit until or after the rates have actually turned positive again. So we can see that here. Rates were negative, and then the recession happened once they turned positive. Rates were negative. Again, that red bar recession happened when rates went positive. Another instance here. Rates were negative, inverted yield curve. Once they inverted, recession followed. And so here, we're just going to have to wait and see. Now we just started to get a positively sloped yield curve between the 2s and 10s, and we'll talk more about that later. So there's still evidence that we could have a recession. It's just the probability is pretty low for 2025. Here's some other recession indicators that we look at. Again, we talked about the manufacturing's negative. We talked about the leading economic indicators are negative. The Philly Fed manufacturing and the Chicago National Fed Activity Index, they're also negative. So it's interesting. These are more negative than we've seen over the last several quarters. So we're watching that. But again, there is mixed data, but consensus is that we don't have a recession in 2025. What drives the market? You guys know that market cycle, right? And there's bulls and bears, and what drives those cycles are the same thing, right? Inflation, interest rates, corporate earnings, the Federal Reserve's actions, and then geopolitical events. And so if inflation is low or down or falling, interest rates are low or falling, and corporate earnings are up, the Fed's accommodative, and geopolitical events are calm, that's a bull market, and the opposite would provide a bear market. We're always looking at the fundamental data, the technical data, and economic data to assess this. So we look continuously every month, every week at about a 57-factor market model that we've looked at, and then about a 50-factor economic cycle that we've looked at. So we're using all three of these types of data to assess where we're at and make our decisions in our portfolios. So where we sit today on inflation, it's been easing with pockets here and there. Some believe that we're going to see some more inflation maybe later on at the end of the year. So that could happen. But right now, the PCE is at 2.4. The CPI is at 2.7. The Fed's target is at 2. So they have a little bit more work to do. But for all in all, inflation is calmer than it has been in the past. When we look at interest rates, again, mostly positive yield curve. The 10 years at 4.56, which is higher than the 2-year at 4.24. So that's good. And again, we'll talk about more interest rates later, but that's a positive factor. Now the Fed is at 4.75. They probably want to be around 2.5 to 3 is what they might call their neutral rate. So more rate cuts are necessary, but there's talk that we might only get a couple in 2025. So if we only get another 50 basis points in 2025, that's not going to get to the neutral rate. So what does that mean? Well, it means that if the Fed stays on that same path, it's going to take longer to get down to that rate. So it might support an equity market for a little bit longer than normal, right? If we just went right down to the Fed neutral rate right now all at once, the outlook would be different. So again, it's not necessarily bad that it's going to take longer to get those rates down. We'll just have to wait and see. The geopolitical events, we have a new administration. The markets don't like uncertainty. So again, we have to wait to see what really happens. There's a lot of talk about what the new administration may or may not do. And it's speculation. We just have to wait to see. So we have to be patient a little bit there. Typically, the first part of the year when a new administration comes in is positive. And then towards the latter of the year, it starts to fall off. So we'll have to wait and see what 2025 brings for us. Now, we also have tariffs. A lot of people are worried about tariffs. I wrote a white paper on this a few weeks ago. If you haven't got that, just request it. The Department of Government Efficiency, that is a new department. Some concerns there is if they're so efficient about reining in government spending, that could cripple GDP and cause a recession or put downward pressure on earnings. So we'll have to see. Of course, we still have wars around the world. The VIX is relatively low based on all these geopolitical events, but that's what we have in the geopolitical category. When we look at corporate earnings, they're positive for most companies, but others will struggle. And so again, tariffs will hurt certain companies and they may not hurt other companies. Same with all of these geopolitical factors. So that just gives us opportunity for more active stock picking. So instead of just buying everything in the S&P 500 or in that equal weight index, it does give us a nice opportunity to do good old-fashioned research, find the companies that are going to thrive in this current environment, and then put those companies in the portfolios and avoid the rest. Okay, so although tariffs are a macro event that can be very negative, at a micro level, at a bottom-up stock picking level, that can also provide opportunities for us. Earnings are a big driver, right? One of the main driver of those factors. And so this year, the estimate is about a 10% growth on earnings, which is above trend. So that's positive. And again, you can see here at this bottom chart that the growth rate 1 year forward and 2 year forward are still positive. Both of these are above trend, which is about 6%. Again, so 6% is your average earnings growth rate. So in 2025, you're looking at 10, 13, and 9.72 respectively. So earnings, again, are positive. If we have a recession or a downturn, those earnings estimates will get changed, most likely revised down, and we will report that at that time if there's a change. Let's look at some market observations. These are just kind of some fun facts to pay attention to. First, we're going to look at bonds and stocks, and then quality and size. So this first graph up here, we see this is the high yield or in favor over the corporate bond. And so again, when the market's in an upward bound, the correlation between high yield bonds is higher. And so we're seeing that those trends continue, that high yield bonds are in favor over your corporate investment grade bonds. When it comes to large companies versus small companies, again, we see large cap companies are again in favor over the small cap companies. And that's now just barely broken below that average. You can see the white line is below that orange line. It's kind of hard to see. So we'll continue to pay attention to that, but the large caps have been pulling back here at the end of the year and into 2025. Okay, so high yield over corporate investment grade and large cap companies over small cap companies. When we look at growth versus value, you can see that value kind of ran out of steam here towards the end of the year, and growth has momentum again. So again, the growth stocks are back in favor. When we look at momentum versus value, again, momentum has been in favor over the value stocks. So that's something we saw earlier, again, when we ranked the sector returns and asset class returns. When we look at U.S. equities versus international, again, U.S. equities are in favor over international stocks. However, when we look at the valuation, we see more value in those foreign companies. So the value advantage is in the international stocks when you look at the forward-looking PE ratio of the S&P 500 compared to the forward-looking PE ratio of international stocks. Okay, so again, then you can see that it's below one standard deviation point below the mean. So that would mean that international stocks might make a comeback. Okay, so you want to buy low and sell high. So the momentum has been in the U.S. equities, but we're definitely recommending that people have some international exposure to their portfolios, and it does look to be an undervalued sector. Again, people have a hard time buying something that's undervalued because it's been performing poorly, and people don't want to buy things that have been performing poorly. But remember, the things that have performed poorly sometimes are the ones that lead you going forward. So you always have to keep a balance between looking out of the windshield of the car and looking out of that rear view mirror. When we look at market weight versus equal weight, again, we spoke about this a little bit earlier, but the capitalization weight is trending, but it is pulling back just a little bit. Right here at the end of the year, you can see that started to pull back. When we look at it at a more granular basis, this chart is showing you sector by sector what's in favor over different time periods. So let's just jump here that over the last 52 weeks, which is basically the last year, we can see that the cap weighted market outperformed equal weight. Now, this was done as of the 2nd of January, so the year to date isn't very meaningful yet. It's only a couple of days of data. That's why I jumped to the 52 weeks. So over the last year, you can see that if it's highlighted green, it means the equal weight had won. Or market cap. So here we see equal, market, equal, market. So again, you can't just say everything should be equal or market weighted. You have to look at the sector and dive a little deeper to understand what's going on. Okay. The next thing that we'll look at is the VIX, the volatility. So surprisingly, VIX has been relatively low. It's about at its long-term average, that blue line. So even with all the wars and elections and fires and all the geopolitical events, it's been pretty resilient to see that we have spikes of volatility, but they've really come down quickly. And again, these spikes of volatility, nobody wants to buy up here because markets have pulled back and there's a lot of risk. However, it's usually a good time to buy because if volatility comes back down, that's a nice trade. Okay, so you got to be willing to buy low and sell high. And again, buying low means buying something after a bad event or a shock and it's not comfortable to buy. Again, that's why a lot of people don't make money in the markets, because they want to buy low and sell high, but because of their human emotions and biases, they end up buying high and selling low. Okay, and we've talked a lot about that throughout the years, the difference between the emotional cycle, the market cycle, and the economic cycle. And we'll talk more about that at the next quarterly update. So what's the outlook? Well, again, we're pretty neutral across the board, so we're cautiously optimistic, and we've been that way for a while because, again, there's just so many moving parts. We still think it's pretty prudent to be balanced. And you see the chart over here on the left. What's interesting about this is a bottoms-up estimate of the S&P 500 from all the analysts. And so out of the 500 S&P 500 stocks, there's 51% of those, or 254, that are on buys, and 49%, or 245 of those stocks, are on holds. And so you can see there's only one sell. So it's really a balanced market, right? It's really 50-50. Half of the stocks in the S&P 500 are on buys and half of them are holds. So again, I'm showing you this here, and I'll show it again later. The reason I'm showing you this chart now is because we are neutral across the board. Even though we think we're going to have a positive year in equities, we think internationals are undervalued in emerging market. We think fixed income, is still important part of the portfolio to mitigate risk. We're neutral. And you can see that balanced approach is also where the market happens to be. So just kind of fun fact to see that the market consensus on the S&P 500 is 50% holds and 50% buys. When we look at sector ranks, we see energy, materials, telecoms, and financials at the top rankings. Energy's been up there for a while. Again, it had a hard year, but again, there's a lot of value there. So this administration is probably going to be friendly to that, and we'll talk more about that in a few slides. But the energy sector still seems to be the number one sector when it comes to looking at a multi-factor valuation ranking process. We're turning to returns a little bit. We calculate out the long-term expected returns on different asset classes. You'll see here that we're starting off with the assumption that the market can do a normal return, which is a risk-free rate of 4 and an equity risk premium of 3 for a total of 7. And so you can see that small caps and mid caps, international, emerging market have, international, mid cap, and small cap have a little bit of excess return expected in them over large cap, but probably not enough to take the risk. But you can see where the returns are. When it comes down to the bonds, again, we see the high yield. We saw that earlier, that high yields were in favor of corporate. And so there's your corporate at 5.4 versus the high yield at 5.66, U.S. bonds at 4.89, treasuries at inflation-proof securities at 5, and the short term at 4.5. Looking at some different estimates, because we never cut once. We always, measure 3 times, cut once. The market consensus at the time was about 13.6% return over the next 12 months, putting the S&P target at about 6.69. If you look at the VIX valuation, it's plus or minus 18, puts it at 69.61. If you look at the volatility on the S&P 500 itself as an estimate of the future, that's plus or minus 12.6. It gets you 66. From our supply side model, we saw 7.61, puts you at 63.14. On the equal weighted basis, consensus is at 7.23, with 62.92 being the price target. And our internal estimate is about 10.74% return with a price target of 6,500. On this slide, what we're looking at, I'm just going to, you can come back and look at this offline, is that we're looking at 27 different analysts and their expectations. So you can see here, Synergy's really in the middle of the pack there. But on average, looking at 10.89, a median of 12.6. And so that's putting the average S&P at about 65.08 12 months from now. So again, it's kind of fun just to see what the different analysts are calling for. Of course, we were all wrong last year. The markets were up 20, and most of us thought they were going to be up 7 to 8, maybe 10. So, we don't know that these will come true, but this is where the estimates are at the beginning of the year. Now what we're looking at here is, again, these that we just showed you in the prior slide were based on the top down. Here we're looking at the bottom up. So analysts are looking at every stock and value in every stock in the S&P 500 to come up with a recommendation. And again, we see here the chart that we showed you prior that is at a 50-50 with an expected return of about 13.6. The numbers that we showed you prior on the VIX, this is how we get there on those calculations. This is a lot of math here. I don't want to bore you with it. What's important to notice is that if you look at the market based on the VIX, the upside is about 69.61. Based on the S&P, its own measurement internally is 66. Consensus estimate is at 66.69 at 13.64. So, we're in the range. The valuation ranges are triangulated both from a quantitative method using the VIX, a bottom-up, and a top-down valuation. They're all making some sense, and they're triangulating. When we look at asset allocation, we're looking at about a almost 6% mean return down here with a standard deviation of 8. So what this means is that 90% of the time an asset allocation model is going to be down 7.5%, up 19, and on average, it's going to be about 6%. So that's what we're looking at for allocation. We're looking at about that 5.9, or rounded off to 6% return. So about half of what equities would be, right? So if the S&P is about 10 to 13, that's what you're going to get for being 100% risk on. And for those people that can't, don't have the tummy test for 100% risk on and want to be balanced, you're going to look at about a 6% return, which is about half of the S&P 500. So that makes sense. The one thing I like to point out here is, I've done this for 30 years, and a lot of people love the idea of asset allocation and risk management until the market does 24 and they do 12. So they're like, well, why did I only get 12? The market did, 24. Well, it's because you're taking off half the risk. And so this distribution shows you that if you want to play the risk off game and you're more worried about losing money or managing the downside, well, by nature, you're going to give up some of that upside. Okay, so again, that's why we like to keep portfolios balanced. You could be half risk on, half risk off. You can be 100% risk on, 100% risk off, but we can get you to where you want to be. We just want to show you the numbers and where they've come from and why we make the fiduciary recommendations that we do for you. So at this point in the cycle, these are just some asset allocation guidelines. Don't follow these specifically. They're just some high-level allocations because everyone asks me for them all the time. So at this point in the cycle, a moderate investor should be about 65% stocks, 20% bonds, 5% cash, and about 10% commodities. And then, of course, you can see what an aggressive investor would be and a conservative investor. Looking at bonds, value in bonds is much more complicated. So I know this chart is an eyesore, but the highest potential again for bonds is in energy, like we saw earlier for equity, and then the lowest risk right now is in financials. Okay. Last thing I'll talk about here is an oil forecast, because everyone likes to talk about oil. What we're looking at here is two things. We're looking at a current forward curve pricing model. So these are what the market is betting on. And then we're looking at analyst forecasts. So the forecasts are in blue and the futures markets are in green. And so you'll see that they're diverging, right, a little bit here. So it looks like we're going to have oil based on forecast. You can see here spot 73.51, first quarter of 2025, 71, 70, 69, 69, 68. So you can see the change between what people are forecasting and what the futures markets are estimating. You can see the difference here. And again, what we might find is that this new administration, if they're friendly to energy, they're going to be trying to keep inflation low. And again, one of the major points of inflation is from oil products and petroleum products. And so, if these are relatively low or stable, that means we could have lower and more stable inflation, which would be a good thing. Welcome. The market would embrace that. Okay, let's look at the sum up here with outlook. Inflation continues to ease, but some are worried about a resurgence in certain parts of the economy, and that could happen. And so we'll watch that. And don't fight the Fed. The market's expecting rate cuts, but less than previously expected. And again, remember that fewer rate cuts mean that it's a strong economy, and we're going to have a longer period to get to neutral. And the Fed's second mandate is probably what we're also paying more attention to is supporting employment. When we get down to interest rates, right? Remember the curve is positive on the 2 to 10s and 2 to 30s. It's still a little bit negative on that short end on the 1 month to 1 year. Okay, but that could be an indication, recession watch, that when they do turn positive, that we saw from our prior chart that historically could mean that a recession is still to come. So again, the jury's out. Increased opportunity for active management. We saw that a 50-50 market consensus on the S&P 500. We definitely believe that our strategies are working well to focus on, active tactical allocation and then stock selection in our focused portfolios. We did have 2 back-to-back years of plus 20. So will it happen again this year? We don't think so. I think it'll be less than that, but we still think it'll be a positive year. First part, again, we think will be pretty positive, and the second half might have some struggles going into 26 and 27. So again, 24 was positive, 25 is expected to be positive, but with some challenges towards the second half. And again, 3 years of positive returns, we hope so. Risk management is once again popular, but it's still losing out to the risk on trade, and we talked about that earlier, right? The risk, if you're willing to take the risk, you're going to get in the markets are up, you're going to get a lot more return. And you're going to dilute return by that asset allocation approach. However, if the markets go down, you're going to be very happy that you're deploying risk management. So the decision to take risk or to manage risk is really an individual question that each one of you has to answer. And so that's not something I can tell you. Your ability and willingness to take risk is a personal attribute. I'm just showing you how to position it. So if you say I want to be 50-50 or 60-40, we'll show you what that means. So again, that's an individual decision that you have to make. Okay. Corporate earnings, again, like we talked about, are resilient. We expect them to grow above trend. When we get to tariffs and a highly successful Dodge Department of Government Efficiency, that definitely could, the talks out there that could dampen GDP growth, which wouldn't be good. So there might be a short-term pullback in some pain, if they're successful. And again, remember, there's going to be some winners and losers, and so that's why active management is in favor. Is just don't buy the index and take all the good with all the bad. We try to deploy active management and find those winners amongst the losers. Bitcoin and other digital assets have support. They've been doing pretty well. And so again, the new administration seems to be positive on that. And the geopolitical events remain, and we'll just have to continue to monitor those, right? So if deficits remain low, that yields may stay low. So again, if they're able to reduce some of the deficit of the government and be more efficient, that could be good. Again, a strong economic growth is positive for reducing government debt. We can grow out of it. So that is a potential positive of some of these policy effects or decisions. And then increased support for domestic energy solutions, like we talked about a minute ago, could be a plus for inflation. So if energy is cheaper and more accessible, right? Supply and demand takes effect there. If prices are down, then that is going to keep inflation down, and people will welcome that. So guys, I thank you so much. I think that was about 35 minutes. So I know I went fast, but I'm sure you're happier than me taking an hour or two to go through this. So please contact us with any questions. We hope you have a very happy 2025. Again, we will be doing an update every quarter. And so this is just the beginning, and stay tuned and call us with any questions. So again, thank you so much, and we appreciate your time today. Thank you.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors, and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.